In my 35 years as a financial professional, the number one question I receive from my clients is, am I going to outlive my income? In retirement, clients face two offsetting challenges. First, generating enough income to fund their retirement. Second is keeping their portfolio in a conservative position that doesn't put their life savings at risk. That is the challenge. This forms the challenging task advisors face when developing a successful financial plan. A plan that matches a client's conservative risk profile while still providing enough long-term growth to meet their client's financial goals. In other words, I don't want to outlive my income, but I don't want to have any risk in the market. Those two many times cannot go together, and it creates a real quagmire for the advisor. The client wants complete safety, but they're not getting enough growth to hit their retirement goals. They're going to run out of money, and thus faces really dilemma. And that's what this workshop is essentially about. How can we solve that financial planning dilemma, having a client reach the financial goals, but at the same time, put the client at ease to not worry about things like bear markets that happened in the dot-com bubble in 2000 or the credit crisis in 2007 and 2009. So when you put your investment portfolio into a financial planning software, and most financial planners, when you go see them, what they're going to do is they're going to give you a questionnaire, and that questionnaire is then going to be input into a software program. And there's a number of very good ones. And this software program, what it does is it takes the questions and gives you a risk score, and then it builds a pie chart around that risk score. And then it says, based on your risk tolerance, this is how you should be positioned. Now, in this particular workshop, the client that I was working with had a risk score of 1. In other words, 28% of the capital of his and hers capital should be invested in the market, and the rest should be in things like bonds and money markets. When we ran that through a simulation called a Monte Carlo, which is in all financial plans, this simulation is based on historical average returns and historical average volatility, or standard deviation annualized. The model generates random yearly returns over 1,000 periods based on the fundamental laws of statistics. The premise of the Monte Carlo simulation is to show the advisor how the fluctuations in a portfolio's returns can affect the probability of them outliving their income. Now, as you lower portfolio volatility, the probability of the plan's accuracy goes up. However, lowering volatility also lowers the plan projected average returns. Now, herein lies the problem. If we invest their capital in this example, in this workshop, in a more aggressive portfolio like the S&P 500, the S&P 500 has shown an average return of 9.3% historically. But it has an annualized standard deviation of 17.1. That's the volatility. The plan showed a success probability of 66%, which is below the confidence zone. That's in the red zone. That's based on 1,000 periods, 1,000 years of returns, and saying, will this plan survive? Will they have enough money when they reach their 80s and 90s? 66% is below the confidence zone. Although the confidence level improved from the initial questionnaire, the 100% S&P did kick it up to 66%, but still in the red zone. Still not acceptable, and still something a retired couple would worry about. And that's the point, is let's get the worry out of your financial picture. Let's take uncertainty out of your financial plan. Now, the next thing we did, the next thing I told the client is, why don't we do this? Let's see how a 60-40 stock bond portfolio would do if we plug that in, which has more volatility and has more risk than what your questionnaire said. But according to historical market analysis, especially the work that Dr. Markowitz and Dr. Sharp did in the 1950s, which was the basis for modern portfolio theory, which is interesting. In 1952, the construct of diversification into a 60-40 stock bond mix was developed in 1952, which has held up. And that has shown an average return of 8.26% annualized, with a volatility of about 10.9. The simulator did predict success. It had an 80% success rate. And the client was very surprised by that, wasn't comfortable with the volatility. And the reason being is when we ran the 60-40 stock bond mix through the Monte Carlo and asked the Monte Carlo, if we go into a sequence of returns where early in retirement you go into a bear market, and I do have a workshop called Understanding the Sequence of Returns in Retirement and how that can affect your retirement, and please do watch that workshop. When we ran the Monte Carlo for this client, the confidence level dropped below the green zone. It dropped into the 60s, and that's not comforting. So in other words, a client, 60, 65 years old, retires, and all of a sudden we move into a 2007 to 2009 or a 2000 to 2003 bear market, and they're not in a good position. They may be in a position to say, okay, let me get out my resume when they're 70 years old, and they leave their Winnebago and Yellowstone and go back to work. Not a fun proposition, and not where you want to be when you're 70 or 75 years old. So it was a dilemma. It was a dilemma for the client, because what did we have? We had a client that said, can I afford to retire? Am I going to outlive my income if me and my wife retired today? And so we need, as a financial professional, I need to tell the client with a degree of certainty, yeah, you can retire, or no, you need to continue to work. So what we did was we first put the client into the portfolio based on their questionnaire, and the plan failed miserably, 56% probability. The second thing we did was we said, let's plug in a diversified portfolio, but of the S&P 500. And of course, the problem is the S&P 500, even though it consists of 500 different companies, the S&P 500 tends to move like a school of fish. They all move in the same direction, even though they're individual fish. So no matter when you're S&P, if you're in energy or if you're in tech, consumer staples, when the markets drop, they all drop. So you don't get that diversification benefit. And that didn't survive. It did do better than his initial portfolio. So then the next thing we did was we said, let's look at the 60-40. And the 60-40 had the best results. However, it failed in a bear market scenario. So the quagmire was, how do we get our cake and eat it too? So the premise of this workshop, and by the way, to get more information or to ask any questions, feel free to click on the link below and set up an appointment with one of my team to ask any questions that you may have. No pressure. We believe that there's no greater purpose than service. If we can answer some questions and get you going on the right track, whether it's with your current advisor, whether you're doing it yourself, and of course, as money managers and as financial planners, we'd always love to work with new clients if that's what you're looking for. So the dilemma is quite obvious. How do we improve the certainty of a financial plan? Well, what's interesting is this is an anomaly in the market today that we haven't seen in 15 years. We haven't seen short-term interest rates this high literally in 15 years. The one-year Treasury bill, as of this recording of this workshop, is breached 5%, one-year T-bill. Now, what's interesting about a Treasury bill is probably the safest investment vehicle in the marketplace, and even safer than cash at a bank. Now, many people say, how is that possible? Well, number one, remember, cash at a bank is only insured up to $250,000, and we saw that recently with a lot of small regional banks having issues. You don't have that. If you have $1 billion in a treasury and you have it at the bank and the bank goes out of business, that $1 trillion is fully protected. you could argue there's nothing safer than a treasury. So what was interesting is that in this particular example, in this particular workshop, he asked the question, well, Dom, interest rates at 5%. Can you do me a favor? Could you plug into the software if I assumed I can get 5% a year on my investments with absolutely no risk for the next 20 or 30 years? And could you tell me if I actually get into the green zone? Well, the problem was the plan failed. It didn't survive. Why? Because there was no volatility, but there was also not enough growth. 5% per annum compounded based on all the inputs, based on the spending and all the things you put into a financial plan. The plan didn't give you a confidence level that was in the green zone. So the next step was, what if we took the interest from the treasury and we invested the interest in a market leverage security and we invested the rest in a treasury? Now, for example, a client walks in the office with $1 million. I invest $950,000 in a treasury bill, a 1-year T-bill, 1 year. Held to maturity, that's guaranteed to be worth $1 million. But I have $1 million, I'm only going to invest $950,000 in the T-bill. I know in a year it's going to be worth $1 million. I only take the interest, in this case $50,000, I invest it in a market leverage security. And let's say that gives me 50-60% of the upside. I then could say of investing the interest in the market and just putting the core into a treasury, will the plan work? And abracadabra, the plan showed a 96% probability of achieving a client's financial goal with an annualized return of 6.6% and with an average volatility of 2.2. You see, even though the index treasury note, in this case we use a very conservative 50% of the market upside, was 2% less a year than the 60-40, the volatility of return was 5 times less. So that bear market scenario did not affect the outcome. How exciting is that? Let's recap what I'm just basically saying to you, is that if we can build a financial plan with a high degree of certainty, what does that do for your retirement? What does that do for the next time you're on a cruise and you're looking at the stock market and you're saying, oh my gosh, the market's down 20%. Takes that worry out of it. Where you're playing tennis, you're playing golf, you're going on these nice vacations with your wife and your family. And this is what you want. You want to take stress out of retirement. And how do we do that? We do that by applying a simple, very straightforward concept that was really developed by Warren Buffett. This is a Buffett strategy through and through. Let's play with the interest and let's keep the principal protected. That's his playbook. And that's what we're doing. It's quite exciting if we're basically indexing a treasury note to the market, which gives us more confidence that the financial plan will work, will survive, will give you that 96% probability. In this particular client's example, you're basically putting something in a capital preservation portfolio on the downside, but giving you market returns on the upside. And you're not locking your money up. You could buy a treasury 1 year, 9 months, 6 months, 3 months, no longer than a year. So if in fact you have any questions, reach out, talk to one of my team, click on the link below, 10 minutes, 5 minutes, whatever you need. If you need some more advice, that's what we're here for. More than happy to help. Thank you for listening to the workshop, and stay tuned for other workshops that we might have.